Okay. If you guys have any questions along the way, Zoom meetings are a little weird. I would much rather be in a room with you guys. But if you guys have any questions, please don't hesitate to speak up. I'd rather be a little bit interactive. It's tough talking to, this is like the Brady, you guys remember the Brady Bunch screen? This looks like the Brady Bunch screen, and so it's tough talking to a wall of people. But if you guys have any questions, I promise you, you won't be the only one that has that question. Sometimes we are reserved for asking questions because we don't want to feel stupid. Don't feel stupid. This is a safe space. Okay. So just, if you guys have any questions, you're going to be benefiting yourself and everybody else, because what we're going to be talking about is a little bit more involved. So, all right. So I will walk you through a conversation that I had last week with a client. She called me out of the blue. She says, Matt, I need life insurance. I said, great. And so I usually tell people, try and gauge what they know about it, right? So like, what do you know about life insurance? This person didn't know anything about life insurance, which is great. So you can kind of craft it from the beginning. So I say, all right, let me tell you a little bit about life insurance. I said, the most important thing about life insurance in my mind is making sure that we get the proper amount. Okay. I'm not going to tell you what you need. We're going to figure that out together. And so I have a process of telling people, kind of crafting how much life insurance they need. And so I'm going to tell you how that works really quick, because I think it's important. This will help you sell more. This will help you sell bigger policies. Okay. If you guys aren't muted, can you guys help me out there? Thank you. So the way that I was taught to sell life insurance, Renee, can you? Okay. The way that I was taught to sell life insurance was, this is an income replacement tool. Okay. So I usually ask them, how much money do they make? And let's say they make $50,000 a year. I said, the best way to replace $50,000 a year is to have a lump sum of money go into a conservative investment that's going to earn you a 5% return. Okay. And that way, every year, that income is going to be coming in. And the only way to really do that is through life insurance. Okay. So if someone's making $50,000 a year, it's a real simple equation. Okay. It's $50,000. It's 50,000 divided by 0.05. Okay. And if you do that with them, I think it's $1 million, but let me just, is that right? Let me just check my math here. 50,000 divided by 0.05 is $1 million. Okay. So you tell her, look, $1 million is your number. And I kind of preface it to him like, you know what, this is going to sound a little higher than maybe you think, but then you reverse engineer it for me. You say, look, if something happens to you and you were to die, you put $1 million into an account that's going to conservatively earn you 5%. It's going to make you $50,000 a year in perpetuity forever. That's how we replace income. Okay. So that's the simplest, easiest way that I've learned to teach people what their face amount should be. Now that we've got the face amount, we have to try and help them determine like what product is right for them. So if they don't know the difference between term and perm, I go into that conversation. I say, I'll tell you what, we'll start with term. Okay. Term is the easiest to understand. Term insurance is nice because it's affordable. You can buy a lot of insurance for a little bit of money. Okay. I said, the only rub about term insurance is that the only way you can get a penny out of a term policy is you have to die. Okay. That's the rub about term insurance. It does not grow any cash value. It is there as a safety net. You pay a little bit of money every month to protect your family in the event that you were to die. Okay. And I think the number that I was taught years ago was, I think 8% of term policies pay out. Okay. And I usually say, you know, that's not a game you'd play in Vegas. Right. But, so 8% of term policies pay out, but it doesn't cost a lot of money. So then I flip the script on and say, now permanent insurance is a totally different animal, and you got to get them ready for some sticker shock. You have to prep them for the number that you're going to put in front of them. So I said, permanent insurance is very different. Term insurance is a straight expense. Okay. Permanent insurance will become an asset for you. Okay. And I tell them, I say, when we're talking about permanent insurance, the monthly premium is going to look like it's more expensive than the term product. Okay. But at the end of the day, if the permanent product is treated properly and funded properly, that's a phrase you kind of want to repeat a number of times throughout this process. As long as it's funded properly, this product becomes an asset. Okay. So, and I usually just I picked some numbers out of thin air. So let's say $1 million policy is going to cost this woman $80 a month or something like that. And you can map that out in your head. You can say, all right, $80 a month is, we'll even round up just to make it easy. It's about $1,000 a year. All right. Over a 20-year period, she's going to pay $20,000 into a term policy, right? So this term policy will be a straight expense of $20,000. On a permanent policy, $1 million permanent policy will cost, gosh, I don't have the numbers in front of me, but let's say it's whatever, 500, well, let's say it's $500 a month for Target. Okay. $500 a month for Target. That's $6,000 a year. That's $120,000 in premium that she's going to pay. Okay. And once you have the illustration, you can walk them through the numbers. Then you can look at how much cash is in the policy at year 20. So I know you've paid in $120,000, but you have $180,000 in cash, which is a net gain of $60,000. So would you rather make $60,000 or spend $20,000 for the same coverage? It's an $80,000 swing. Once you start talking to them in that kind of scope, they kind of understand what you're getting at. Okay. So make no mistake about it. If a permanent policy is funded properly, it is, to say it's less expensive than a term policy is not true. It's totally different. It's an asset versus an expense. Okay. So that's kind of how I frame it. After I do that, I ask them, I said, which way would you like to go? Or what would you like to learn more about? And you guys, 8 times out of 10, they're going to say, tell me more about this permanent life insurance, because they need the insurance, right? So which way are they going to get it? Okay. So I'm going to walk you through a strategy really quick that I really like. How many of you guys have read or are aware of this book, The Power of Zero? All right. This is a great book that you all should read. It's going to help you sell more of these policies. It's going to help you speak to people more confidently. There are a lot of really good talking points. It takes people like 2 to 3 hours to read. It's not that long, but it's a little intense. This guy is all in with this type of strategy. I'm not all in with it. This guy's trying to teach people how to create a tax-free, 100% tax-free retirement, which you can do. He spells it out in the book. There's a lot of heavy lifting that needs to happen for you to do that. Using permanent life insurance, he even references the Index Universal Life is his backbone to this strategy. Okay, so I buy these books and I hand them out to people who I'm gonna pitch. I give it to them before. I'm like, I want you to take a look at this book, read it if you can, read the first few chapters before we meet. It's a great way to kind of prep for a meeting like that. So these books are like, God, on Amazon, I bought a bunch of them last month. They were like $10. They're great to just have on the shelf and just hand out to people like it's Halloween, right? So this strategy, the way the strategy works is you build a proposal for them so that they are going to fund a policy for a certain amount of time, 20 years, 25 years, depending on their age. You can do it any way you want to, but the longer that you fund it, the harder the money is going to work for them. So you fund this policy for, let's say 20 years, and then you're going to stop paying in. Okay. You're done. Then for the next, let's say she's 40 years old, you're going to pay into it for 20 years. And then you're going to have her withdraw for 40 years. And when they withdraw that money for 40 years, all the money that they get out of this policy is tax-free. This is really good. This product is really, business owners will really listen to you with this, because as soon as you say tax-free, you're going to have their ear. because they don't quite there's nothing really else like that in the market where you can get tax-free returns on your earnings. Okay. The only thing out there is a Roth. Okay. But not everybody is eligible for a Roth, especially if they're making over, I don't know what the number is right now, but 120,000 if you're single, 165 if you're joint. Maybe if you're making more than that, you can't have a Roth. The other thing about a Roth is you can only put in so much, like 6,000 a year. That's the most you can put into a Roth. With this strategy, you can put in 6,000 a month if you wanted to. Okay. So I'm going to teach you how to do an illustration so that you can see how I do this. But before I do, I'm going to walk you through how I explain it to a client before I drop this massive document in front of them. Okay. So what I generally do is I say, when it comes to term life or permanent life insurance, when you pay your premiums into a permanent life policy, let's say the premium, I'll just pick an arbitrary number. Let's say your premium is $200 a month. Okay. $200 a month. And that's your target premium. And I even have to tell them, like, there are different levels of premium. Okay. There's something called target premium, which is what my company says is a healthy amount to fund this policy. It's also the number that you and I get paid on. And we get paid on target premium. But I tell the client that this is the amount that my company believes you should fund this policy so that it remains healthy until you die. Okay. Because you have to keep cash in this account. So that's what target premium is. I said there's even a level of premium below that, which I don't really even, I tell them there's something called minimum premium. You can quote minimum premium in these policies. Minimum premium is like the cost of insurance plus fees. And like, you should never do that. Okay. Just sell them a term. Okay. They're buying a term policy is what they're doing. If you do minimum premium, target premium. So target premium, when you pay your premium and you're paying target, and let's say it's $200 a month, let's say $50 a month of that is the cost of insurance and fees. So $50 a month will go and take care of the cost of insurance and fees. That extra $150 a month goes into an account. Okay. And what differentiates these types of policies is how the money is handled in that account. Okay. The product that you and I are talking about today, the Index Universal, you have two choices, right? You've got the S&P 500 and like the S&P Mark 5%. There's two products that you can choose from. You can do, and you can split it up if you want to, 50% into each, 100% into one, or whatever. Okay. If you're selling a VUL, the money that goes into that account is invested in mutual funds of their choice. Okay. If you do just a straight universal, that account earns a fixed 3%. Okay. So for what we're talking about today, we're talking about the universal. So you got $150 going into, let's say, an S&P 500 account. What's important about our S&P 500 is we don't actually, I talked to Tom Robb about this, who's our like expert on this. I said, this doesn't go into an S&P 500 account, does it? He goes, no. He goes, you're paid this. We're paying based on how the S&P performs. Okay. So the other thing that you have to tell people about too, obviously, one of the more attractive things about this product is it has a floor. So a 0% floor in this account. So if the S&P is doing like what it's doing this year, which is why I think you should be talking about this product to people, because people are freaking out, is like, if the S&P is down 22%, the money in this account hits a floor and it's at 0. Okay. So you're protected. Look at what happened in 2008. It went down 38%. You would have lost 0. Okay. On the flip side of that, you've got a 12.5% ceiling, which is still very healthy. Okay. And I'll show you in the proposal that this thing is averaged about an 8% return, which I think is really attractive for the amount of risk that they're taking on, which is very little. Where can you get 8% return with almost 0 risk? Okay. And obviously, so you're talking about low risk, tax-free. I don't know of any other product out there that does this. Okay. So when I tell them you got $150 going into this account, $50 going for fees, the other thing you want to tell them is like, where the magic happens with this policy is you can overfund this account. Okay. So while target is $200, you can put substantially more money into the account. You can put upwards of $1,000 into the account, and the maximum you can put in is predicated on what the face amount is, right? So every face amount has a max that you can put in. So in this instance, you can put in $1,000. So what that means is when you're paying your $1,000 a month premium on this policy, $50 goes and takes care of the insurance and fees. And then now you got $950 going into that account every month, month after month, year after year. And that's how you really maximize this strategy. Okay. Does anyone have any questions? Is this clear so far, Cameron?
Hey, so I'm relatively new. This is my second month as a agency owner, and with this coming out pretty much the same time frame as, and you mentioned, this would be a great product for business owners. Is this something that we could pitch to them and say, like, hey, like this is, a write-off, something like just a little more icing on the cake for them to, be more interested to at least have a discussion?
So you could do this in like what's called a buy-sell agreement, like in a partnership. A partnership. There are business life policies and there are personal life policies. This is a personal life policy. I don't think you can write it off. I don't think the life insurance premiums are deductible. If it's a business expense and it's a buy-sell agreement, that is something that is written in the company name. And that would honestly be probably a question that you would want to run by an accountant, to be honest with you. So that's my easy out of that. I think I think you can write off. I think you can write out. It's a business expense if it's a buy-sell agreement, or if it's a key man policy or something like that. But I would get a firm answer from an accountant on that.
Yeah.
So
okay, thank you.
Cool. Yeah, Greg.
So Matt, the old IUL policy that we just replaced had a 9.5% cap, and I watched that go down from 11.
I know.
In just a couple of years.
I know.
Is there any verbiage in this new one that says that this thing's going to stay at 12.5, or could we be in the same boat where? Because it seemed to me when they went from 9.5 to 12.5, I said, "Wow!" Because by the way, I stopped selling IULs because of the 9.5% cap. The new policy, of course, they come out at 12.5, and I said, "Okay, this is a game changer for me. It makes a lot more sense because I can't sell a VUL." And so that was the way I was opting to go. Is there anything that's saying that we're locked in at 12.5, or can we be in the same scenario as we were just a few years ago?
No, I asked Tom that question too, because that was a concern of mine. I love the old IUL too, because it started at 11. That was attractive, right? And then it quickly it dropped twice. It went down to like 10, and then it went down to 9 or 9.5. And I was like, what the hell? I was kind of pissed. And so I stopped offering it because I would have been upset if I was like, if I sold that to a client and I said, hey, it's 12.5%. Now you're only going to get 9. And no, there's no promise. There's nothing in there that says this is going to be locked, So to answer your question, there's always a possibility of that happening. And I'm like, Tom, why doesn't it ever go up? Like, why can't we go from like 9 to 10 or 10 to 11? And he's like, I don't know, Matt. So that is a risk, like in anything, there's no promise. I can't believe how fast it happened last time. It was a bummer.
Yeah, I'm only a 4-year agent here, and I watched it happen from when I started to now. And I'm like, and again, because I have the ability to write VULs, I just transferred my whole story. I just stopped even offering the IULs because I didn't think it was. I thought the product was lacking at 9. I think it's 9%. I don't think it was 9.5. I think you're right. And I thought that just didn't make any sense. Anyway, I don't want to hold up more of your time.
No, I agree. I mean,
something that I didn't know.
No, I appreciate you bringing it up. I pivoted to VULs pretty quickly too, and this strategy, the way I'm going to show you how to quote this, and this strategy is also sound with the VUL. So just keep that in mind. All right, so let me think if I've missed anything else before I jump into this proposal. All right, so you guys, I'm recording this and I'm going to post it on YouTube so you can have access to it whenever you want. I'm going to show you a pretty intricate way to do this type of illustration, and I'll go slow because it's It's pretty involved, but once you learn how to do it, you kind of know how to do it, but I want you to kind of follow me. So, hang on, I got someone in chat. Sorry, I forgot I had a chat function here. Do you have to be over age 65 or officially retired to start drawing from this policy? No, you can get to this money as soon as you want. You know, there's no early withdrawal. This is not a retirement. This is not, while we position it as a potential stream of income for retirement, it's not. There's no penalty for an early withdrawal, and you can get to the money whenever you want. So California, you guys are still maxed at 8.5. That's a bummer. Okay. All right. Thanks, you guys. All right, ready? I'm going to try and share my screen here, so bear with me. Let's see if I can. I'm just going to shoot to the desktop. See if I can. All right. Can you guys see this? All right, cool. Ready? So I'm going to pop into submit an app. I'm just going to start a fresh one. Okay. And I'm going to use the gal, whatever we'll say. So Amber Miller, let's say she's 37. She's female. I'm in Idaho. Indexed. Find available options. I'm going to use the new one. I'm going to write into quotes and illustrations. All right, here we go. So let's say she's a client. I have definitely taken my training. You guys do your field underwriting, you know, just guess. You can ask the questions. When it comes to field underwriting, I usually ask, you know, age. I do ask height and weight if you guys really want to do your best with this. And the two questions I asked in field underwriting are, have you been diagnosed with anything, and are you taking any medications? Those are the two. That's as deep as I go. And then as they give me answers, I will do my best to just try and place something. So if they're, I almost never do Platinum Elite unless I know that they're like a triathlete, you know, or if I know that they live a very healthy lifestyle and they got but Platinum Elite, you know, whatever, 5 to 10% of our people, you know, are eligible for that. So let's just pick Platinum Choice. It doesn't make that much difference in the illustration if you're wrong. So don't worry about it, because we're putting in so much money on top of the cost of insurance and the fees. If they get rated differently than you quote, it's not going to make a huge shift in difference to the outcome of this policy because we're funding it with so much extra cash. Okay. All right. So the first thing that we do is I go to this solve for box here, and I solve for, I guess, let me predicate this too by saying you want to ask how much they want to fund this policy with. Okay. What are you willing to put in this policy? And you can run as many of these as you want. Okay. But so let's say they'd say, look, I got $1,000 a month. What does $1,000 a month look like in this policy? Okay. So what we want to do is build a product where the most you can put in to this life insurance policy is $1,000 a month. So you can tell this system at $1,000 a month, like, what is the maximum that we can, what's the face amount that we need to determine where the maximum we can put in is $1,000 a month. Okay. And that's what we're trying to determine. And the system does it for us. So we're going to solve for premium/face amount, or premium/face income. And then you're going to say, all right, when are they going to start withdrawing from this? All right. So they're going to start withdrawing. She's 37. Let's have her start withdrawing at age 62. And then how long do you want her withdrawing money? And I always go to 100. So let's do it for 38 years. Now, the next one is we're going to solve for face and income. And we click OK. Okay. It's going to do what it needs to do. Just click OK there. Now we're going to put in how much she's going to pay a month, which is what we do down in payments. Okay. So it's set for target right now, but I want to go to specified. We're going to tell it how much we want to fund this thing for. $1,000 a month. 12,000 a year is what will show up. Well, no, it actually stayed. Well, let's see. Yeah, it changes to 12,000. Okay. So we got that set. This one right here, years to pay premium. This is important. So she's 37. She's going to start withdrawing at 62. I want her to pay premium for 24 years. It's either 23 or 24. I can fix it if I'm wrong. Okay. So we do that. And the last little thing that you want to do, this is kind of a hidden little option, is there's an increasing death benefit and a level death benefit. We want to change this policy to a level death benefit option when they start withdrawing. And the reason we do that is because it will allow her to put more money in for the 24 years that she's funding it. Because if we did level, she couldn't fund it at the amount she wanted to. So we are going to change this. We got to use the second box here. We go all the way to when she's 62. Oops. 62. We're going to go to level and click OK. And it's going to make, that's the last little thing that we do to make sure. Okay. And that's it. All right. That's it. So we're going to hit run illustration.
Hey, Matt.
Yeah.
Just a quick question on that. So with the increasing death benefit, if she passes away prior to age 62, she's getting the face amount plus the cash value. And then at age 62, like that first year, if she were to pass away, the cash amount essentially nets out against the face value, correct?
Yeah, it'll show you the death benefit option in the illustration. So everything will be accurate. So you'll be able to see how the death benefit changes throughout the whole life of the policy. Okay.
Right. Okay. But that's something we have to communicate to them that, hey, you could potentially, now I don't want to say necessarily lose the cash value once it's flipped to a level death benefit, but is that, well, I guess you'll show us that how it changes.
It'll show you. Yeah. All right. So this is a monster report. It's 26 pages. So this is how I present it to the client. Actually, let me just make sure that I did this right. Damn it, I missed it. So I'm off 1 year. So I'm going to have her fund it for 1 more year. Sorry. So 25 years. I don't want there to be a gap. 25 years. All right, run illustration. Where are you guys? All right, so it's running. All right, here we go. So the first thing I like to show them is on this page here. This is a nice page, page 4. It says, hey, so over the course of these 24 years at $1,000 a month, you will have paid in $300,000 of premium. Okay. What is coming to you is $1.538 million of tax-free money. So you're going to invest $300,000 and you're going to get 1.538 out of it. Okay. So that should make them want to pay more attention to what you're about to tell them, because that's pretty attractive, right? So we're going to go all the way down. Actually, let me show you. There is something I'm going to stop on, right? Right here. So on page 12, this shows you over the last 20 years how these two funds have performed and how this policy would have paid. Okay, so the S&P 500, you can see back in 2001 to 2002, well, the year of 2002, it did a negative 23%. You would have been protected. You would have got a 0% return. Okay. The next year it did 26.38. You would have got 12.5 and so on and so on. Here's the big whopper, 38.5%. When the economy crashed, you would have been protected at 0 and so on and so on and so on. The last 3 years, 12.5%. So over the last 20 years, historically, this thing would have returned you almost 8%. Okay. Which is actually better than the S&P. The S&P did 7.38. Okay. This beat it. The other one is this S&P Mark 5% ER. And you guys, I was handed a different PDF on this. It's my understanding that we are actually crediting an extra 3.5% in this account. So this, I believe, is not accurate. So we are going to give a 3.5% kicker to every one of these returns. Okay. I was handed this by when I went through this training a month ago. Okay. So there's actually a 3.5% floor on this account, and there's no ceiling. But as you can see, this specific account hasn't done better than 13.17. But if it did 13.17, they would have got 16.67. So based on what I was given, this account return, I know it says right here 6%, but in what I was handed a month ago, the average return of that account is 9.6%. Okay. So those are very attractive returns for the risk that they're taking on. Okay. Now we're going to go down to kind of the nuts and bolts of this. And it's page right here. So I walk them through this. Okay. I say, all right, look, this is what this is going to look like. In year one, pay $12,000, year two, year three, year four, and so on. $12,000 a year. This is your cumulative premium. This adds up. This shows you how much you've paid in over the course of time. And then over here, we talk in this column, right? Here's your death benefit. Remember, you have to remind them this is a life insurance policy. Oh, which reminds me, a couple things. Shoot. Their face amount came out to be $267,815. That's the face amount needed to be able to put in $1,000 a month. Okay. I also go back and I run a target premium illustration based on that face amount, because I want to know what target is. Okay. Target premium on this face amount for this account is $193 a month. Okay. So she's able to put in over 5 times what the target is. Okay. Based on this illustration. Okay. She can do it at target premium. It's just not going to work this well. Okay. So death benefit is over here. I say the contract value is the amount of cash that's in the policy, or the amount of cash that's in the fund. Okay. The surrender value is the amount of cash that is available to her. And I say the difference between these two amounts in these two columns is essentially an early termination fee. If she got to year 10, I was like, Matt, I'm done with this. Give me my money. Give me my $128,917 that's in my account. I said, well, we're only going to give you $125,408 because there's an early termination fee. This lasts for 14 years. You can see in year 15, these numbers match up. Okay. You're fully vested at that point. But if they want to bail on it beforehand, I mean, this is our way of keeping them in the policy, right? You have to tell people that if they want to work this strategy, it becomes a formal part of their financial plan. Okay. This isn't something that you necessarily just want to try out for a few years and then be like, this isn't working, I'm out of here. You can waste a lot of money doing that. Okay. You can see if they bail in year 4, they paid in 48 grand. They're only going to get $35,000. That's not why we're doing this. This is, you want to die with this policy in force. Okay. That's what you want to be doing. So let's go to the next page. She's going to pay until she's 62. Okay. And then she's going to stop paying into it. Now she's going to start getting her money. Okay. She's going to get $40,478 a year till she's 100. Okay. Till she's 100. Tax-free. Okay. So how is it tax-free? I go down a little bit farther. I go down to there's all these different things in here. I go all the way down here. Okay. And I go to this page. All right. This lays out a little bit differently. So we give you're paying in 12 grand a year for 25 years. Now, the first money you're going to get out of this policy is called a surrender. And I tell them that all of these add up to all of these. This is her cost basis. This is what she's paid into the policy, which is $300,000. You get the 300 grand out first. We don't tax a cost basis. It's like when you buy a house for $500,000 and you sell it for 750, you don't pay taxes on the $500,000 that you paid in the policy. That's what this is. Now, the rest of this is all earnings. Okay. So why don't we tax the earnings? Because you cannot tax a loan. That's the loophole in this whole project. Okay. You do not tax a loan. And they say, well, Matt, don't you charge interest on a loan? In which you say, yes, we do charge interest. And I believe it's 3%. But Tom Robb also told me we also credit the account 3%. So it's a net zero loan is the language that I was taught to use with this. The other thing that you have to understand is that while even if we're charging 3% and we're crediting 3% back, I don't quite understand the mechanics on how that works. But it's also earning interest on, it's earning an average of 8%. So would you pay a 3% loan on something that's earning 8%? Yes. Okay. But we're crediting 3%, we're charging 3%, and they're still earning whatever the S&P is doing. Okay. And again, remember, this is a life insurance policy. So if she dies when she's 82, she will have gotten all of this money out of the account, and it's still going to cash out a death benefit of $555,944, which again is tax-free. Okay. That's how I position this strategy. That's how I sell it. And I think that's what I got. Do you guys have any? I'll take questions now if you guys have any. That's what I got for you today. So what do you think?
Oh, I haven't run this new IUL, but what is the base rate in the illustration with the VULs? They use 6% max, which is very conservative. What are they doing with the IUL?
This one, they run it at an assumed rate of 6.27.
6.2.
So
still conservative.
So these numbers
are selling it.
Yeah, these numbers are conservative. I usually run my VULs. I used to run them at 8. Can we still?
I can't. 6 is the max we can run a VUL at.
I used to run them at 8. So this is running it at 6.27, which based on the numbers, historical numbers, it's low, So we'd like to think, you can't promise, past returns cannot guarantee future benefit, all that stuff. But, but that's this illustration, I think it's at 6.27. So
you do, as your selling point, or at least the selling point I use is if you go back 50 years in the S&P 500, you're getting back a 10+% return. And so if you're dealing with somebody that's younger and say, hey, if you look at the last 50 years and you average it together, you're getting a 10% return. And this model is only modeling 6%. So you could actually look at these numbers and say that they are really on the conservative side.
Yeah, exactly. Cool. You guys have any other questions?
Hey, Matt, I got one. So you probably said it. On this IUL, I'm 65, and they got a certain amount of cash value built up. They pull it out. They're retired. Is there a capital gains tax on IUL?
Yeah. So let me tell you the one thing. I guess this is an important part. And thank you for asking, Ram. The one thing that you have to tell people is that, like, once they start withdrawing from this account, like if they were to ever cash the policy out, like maybe when they're in their 70s and their 80s, and they're like, all right, give me all my money, then the entire bulk of their earnings are subject to tax. So like I tell people, like, you want to die with like $13 left in this policy. Like that's your goal. Okay. So that's the only way that currently where you would get taxed is if this policy lapsed, or if you shut the policy down and you withdrew all your money, then everything is taxed. Okay. So that's an important part.
So the key is don't let the policy.
No, don't let it go. So once you get someone in this, like, again, you want to tell them this is something that This is something we want you in for the long haul. It's a formal. And the tough part about this type of product, you guys, and I've had some people in these products for a while now, is like, they don't really look impressive, until like year 12. And so you have to remember this is a marathon, not a sprint, And so as you're doing reviews of the people and going over stuff like this, like, have that original illustration, keep that in their file or keep it saved somewhere so that you can revisit it. And they'd be like, Matt, this I've paid in. I mean, if you look at that illustration, they've only paid, let me see if I can pull it up again really quick, because it's, after year 7, they paid in $84,000 and they haven't even made their money back yet. They're like, man, what the hell? This isn't really what I signed up for. And you're like, well, it is, but you got to remember, like, where the benefit, like, you have to give the magic of compound interest is where the most important part about compound interest is time, and so you have to give it time. I mean, this thing doesn't hit, you don't start seeing money in the contract value until years between 9 and 10. So, but you have to keep them, you have to keep their eye on the prize. I mean, like, remember, you're going to be getting $40,500 a year out of this thing tax-free. Once it takes time for this thing to really get ramped up for it to be working properly. So, you'll have some people that will go through this stuff with a fine-tooth comb, man. They will go through everything. You got to be prepared on how to answer all those questions. You're going to be asked questions you don't know answers to, and that's totally fine. You've got people that can help you with those answers. You can say, the last presentation I gave was a big one. Some guy wanted it $5,000 a month. And so that's when I call in Tom Robb, and I'm like, Tom, how do I answer if he asks this? How do I answer if he asks that? And he will give you all the answers. And so, once you get into the nuts and bolts of it, you got to really do your best to educate yourself. And I like to predict what questions I'm going to be asked. And I also pretend like I'm buying it. How would I look at this product? I can be skeptical too. And so so think about it as a consumer. What questions would you have about it, so that you can be best prepared for the pitch? Some people are gonna be like, cool, man, like, that looks great to me, let's go. Like, I've sold some policies where like, yeah, man, that's fine, let's go. Like, how do we do this? And then we write it, and it's gonna be everything in between. So yeah.
Going back to that prior question that was asked, does that hold true if, like, let's say you're doing kind of funding this as a buy-sell agreement, and then you pull out the cash proceeds to purchase an ownership stake, 50-50 owners, you fund this, and at a certain point use the proceeds to purchase out your partner, let's say, but keep the policy. If they ever cancel the policy, does that amount they withdrew become taxable? Or is that too technical for now?
Yeah, all the earnings would be taxable in the event of the policy, not being enforced anymore. So
even if it was years down the line, they just 10 years later, let's say they cancel the policy, they would retroactively go back and make that taxable.
Yeah.
Okay.
Yep. Yeah. You don't want to get hit with a big tax bill when you're like, 85 years old or something like that, because you're done with it, so it's a real commitment. So Aaron, the ceiling on the return that you're talking about is set by the specific company you're writing with. I would say yes. Like, I'm only familiar with this one with Farmers. I'm sure other IULs have different ceilings and floors. So yeah, it's set. It's not like a universal floor and ceiling in the industry. It's something that every company kind of has their own one to do with. Bobby, after the health assessment, do you average a lot of clients that will have a worse rating class? What are your talk paths through that? Yeah. So if you get rated differently, like, you could go back. So remember this amount, 40,478 is what she's getting at Platinum Choice. Okay. Let's go back and change it to Platinum. How much does that affect the premium? Again, I try and be conservative when it comes to rating people. I think you're always hoping that they're going to come in better than what you wanted. But if she came back Platinum instead of Platinum Choice, It's almost nothing. Can you guys, did I not share my screen? That was dumb. Sorry. All right. So before it was 40,500, about 40,500 when she was platinum choice. I just changed it to platinum. It only changed the outcome by $300 a month. I mean, that adds up over time, but it's pretty insignificant. Like I said earlier, that's just changing the cost of insurance inside the policy. And if you bust all the way down here, somewhere down here, it shows you the cost of insurance. So this is at platinum. $67 the first year, $104 the second. I mean, it's like, that's $8 a month, right? That's platinum. If a platinum choice, it's very insignificant. So when it comes to, like I said, so much, this strategy, so much of the money is going into the cash that a change in rating is nominal. The bulk of this money is going into that account. Okay. So it's going to perform better for you at this. You're just putting so much money into it. If you get a worse rate, it's a blip, you know, so. Okay. All right. There you go. Was this good? Was this helpful for you guys? I think this is something that you guys should, when you're talking life insurance with people, start the conversation with them and say, look, just educate them on the difference between term and perm right out of the gate. Even before you start talking face amounts, even before you start talking premiums, talk to them about the difference between term and permanent. And after you're done doing that, if you do it right, they're going to want to know more about permanence because it's an asset. Like they're buying the same thing. They're buying life insurance. Do you want money back from your life insurance, or do you want it to be an expense? Like it's a silly question to ask, but you have to remember they're buying a life insurance policy. There's an initial need here, you know? So do you want it to be an asset or do you want it to be an expense? Like you want to break it down and be super simple. And the other thing is like, the other thing I tell them, I'm like, look, this is going to look more expensive, but I'm going to show you that it's not even in the same league. Okay. It's not more expensive. It's an asset. Okay. So, the vehicle does the same thing for you. If you were to die, this money is going to go to the people that need it. Okay. But do you want it to be an asset or do you want it to be an expense? Almost everyone's going to say it's an asset, and then you teach them. Okay. So that's how you should be, you know, positioning this to anyway. And then the other thing too, you guys, is I pitched this to this Amber Miller. I actually did one and she replied to me. This is going to happen too. They're like, you know what? I think we're going to lean maybe. You don't have to do all or nothing. You can do blended. If she needs $1 million worth of insurance, there's no reason you can't do $750 in term and $250 in permanent. Okay. Or $500 in term and $500 in permanent. You want to work around their budget. Okay. So what can they afford to do? And you know what? Most people really like the strategy. They see it. They can see the value in it. They see the worth in it, but they might not have $1,000 a month right now. Okay. And in this case, you say, you know what? It's totally fine. Let me tell you something. Our term product is convertible, which means let's get the $1 million in term in force, because that's the most important thing. Let's make sure you're covered. We're going to write a term policy for you right now for $1 million. When you're ready, we can convert into permanent. Okay. And I'm like, look, we can break this thing in half. I mean, we're going to keep 500 in term and we're going to do 500 in permanent, or we can do 750 in term and 250 in permanent. You're still going to have the coverage, but we can still work this strategy. Okay. And you can do that conversions. If you guys have never done a conversion, it's the easiest thing in the world. They just have to sign a freaking form. Okay. They've already earned their rate. They don't have to go through the process. They don't have to reapply. They don't have to get a paramed exam. Like they sign a form. How much do you want to convert? 250. Done. You just wrote a fat policy by doing that. So conversions are awesome. So that's your last line of defense. If they're like, well, I can't afford it right now, which is fine. That's a lot of money, you know, but that's how I position it. That's how I've sold some really big policies. That's how I've planted the seeds for people who have come back to me and said, I think we want to do that now. So that's the way I've done it. So there you go. All right, you guys. Well, I appreciate you hanging on and listening to me. For you guys, I know you guys know that I do this training, agency launch. I have this whole platform out there for you guys. The training platform is very similar to what I just did for you. Okay. There's just 46 modules of stuff of me telling you how this stuff works. Okay. It's just like how I've presented it to you. Okay. So some of you guys are in it. Some of you may be interested in it, but for today, I'm going to give you guys, if you guys are interested, I'm going to drop a 20% off code for you to the end of the week. If you guys are interested in getting in there. So if you guys want to get in on that, it's there for you. It's everything that I've learned as an agency owner in the last 18 years. So I appreciate you guys are all in my texting community. I appreciate you guys being in there. It's fun. I love communicating with you and chatting with you and all that stuff. So it's amazing. So I'll shoot you guys a text and let you know what that code is going to be and what it's good for. And you guys know I'm here for you. So if you have any questions, just hit me up. I'm happy to hop on a phone call or shoot some text messages or whatever. And I'm rooting for all of you. So there you go. Thanks, you guys. I appreciate it. All right, guys, let's go get them. Have a good afternoon. Take care.
Thanks.
All right. Bye-bye.